battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are the Stenger Family Office. For the past 44 long years, it's been our family's mission to deliver you both clarity and confidence to help secure your financial future. It's episode 185, hard to believe, rolling right to the halfway point of 2025, if you can believe it. We've got some incredible events coming up very, very soon. We've got our open house on the calendar here in a few weeks. Register for that if you are not yet a client. If you are a client, you may enjoy it as well. And then don't forget the big event is coming up very soon, October 16th and 17th. And Producer O, if you don't mind throwing that up on the screen there, in Oak Brook, we've got Maggiano's on the 16th, but then the most important day is the 17th. Come back to Gibson's for a half day of presentations. We've got 3 amazing guest speakers coming into town to talk to you about what's going on in the markets and a variety of other topics. And then we're going to tell you what we're doing inside, behind the scenes with the portfolio. And you just can't miss that event. That is our flagship event. Invites will be sent out officially the first week of June, I believe, is what I've been told by Katie the Greek, and should be going out to you soon. But when you do get that invite, don't forget to register. You got to get on it quickly because that thing will fill up very, very fast. Again, October 16th and 17th, Investor Day 2026. But it's this year, October 16th and 17th. Let's jump into the show, The Big Lie. What is the big lie? Been thinking a lot about this lately. Remember, we ultimately did keep every single Stenger Family Office client invested in on their plan. We lost one. They got back in. Everything's good. And I was just reflecting on why, though, so many people did panic in other places if they didn't have a fiduciary advisor. And I think it boils a lot down to this big lie, which is emotion-driven. It's believing the simple fact that this time it's different. If you don't have the perspective of data mass statistics, if you don't have the historical lens of what's happened to the markets over the past 200 years, you could believe from the media, that's usually where this lie comes from, that this is different than anything we've ever been through in the past, that the tariffs were different, that COVID was different, that '08 and '09 was different, that Brexit, the taper tantrum, 2001 with the tech bubble, 1987, all these different panics that we've gone through in the stock market are radically different than anything else. Now, they are different in the sense that we hadn't had a COVID before. We hadn't had an '08 and '09 before. We hadn't had a Grexit before or a Brexit before. And that is true. But the saying is that history doesn't repeat itself, but it sure seems to rhyme. The rhyming part of history is that you are invested in companies. You cannot forget that. The stock market is a collection of actual companies. Companies are a claim on real assets. So when we go through these big downturns, when we have corrections, when we have pullbacks, remember that these companies nowadays are stronger than they've ever been. It's not that one or two of them aren't going to have a problem. One or two of them aren't going to jump on a giant rake like United Healthcare is right now. But over time, they're going to be resilient. These companies made it through the most severe of these corrections, which I would say was COVID. And so, again, I look at the people now who are panicked over the Trump and the trade war and tariffs and all the rest of it. And I understand the frustration. I understand why people are upset. I think we can all debate that there could have been a different way of doing that, different way of going about it. I think a lot of people actually agree that we need to hold China's feet to the fire a little bit. But the way that it was done was probably a little bit brash. We can talk about that. But the fact that people who didn't panic during COVID now were thinking about panicking during the tariffs is just an interesting window into if you let emotion, if you let politics drive your decision-making in the portfolio, you can make some seriously damaging mistakes. Now, we are just barely into the first term of the first year of the Trump presidency. You are going to have midterms coming up very soon. You're going to get a tax bill, the one big, beautiful tax bill that we will talk about. We're going to do a show on bullish next week, myself and Sam Hardy interviewing Chris Jordan, our head of tax here at Stenger Family Office, talking about the potential tax changes that are coming up. But all of this to say, there is going to be plenty of reasons to panic the next 2, 3, 4 years. Now, I've said this on the show consistently now since we started it in 2020. I started writing weekly insights. If you remember back to the weekly insights days, I was writing those in 2018, 2019. I've been talking about this. There's going to be 10 reasons every year to panic. Now, for some reason, everybody forgets that I said that. So again, I'm going to tell you, drill this into your memory. I am telling you today, It's still just May of 2025. There's a lot of baseball to play. There's a lot left to go here in the Trump presidency. There's a lot left to come in your financial plan. So just be prepared that we're going to have more corrections. We're going to have more volatility. I talked about Mr. Market last episode, and go watch that one. We talked about what Mr. Market does, but Mr. Market's going to exist forever. If you're going to be in equities, which are the best inflation beating asset class on earth, you're going to have to deal with Mr. Market. And Mr. Market is sometimes going to scare the pants off you. Sometimes it's going to be the media. And the media is absolutely awful with this, where they are not designed to keep you on a plan. There's good parts of the media, there's bad parts, but one of the bad parts is that they are driven by clicks and views. They used to be subscription based, where you'd sign up, you'd pay a monthly fee. It doesn't work like that anymore. Now, all these shows are dependent on you clicking and watching. And they have data now where they know if they say a certain word on the show, you are going to watch longer, you're going to click more because you are scared. Fear sells. If it bleeds, it leads. We've talked about this. So just watch yourself in your financial plan, because if you start to buy into the big lie, which is this time it's different, you are going to forget the constant reminder that we will give you, which is the opposite. This too shall pass. And you heard a lot of that when we were during COVID. We would say that almost weekly on the show: this is going to pass. Let not your heart be troubled. The world is going to come back to normal. And you know, we almost have amnesia as investors, where we forget how bad it was just a few years ago. I mean, there were points during COVID where people thought we were never going back to normal. In fact, they called it the new normal. People said that the stock market would never be the same. The economy was fundamentally going to change. And here we are 5 years later, and things are basically back to normal. So just remember, don't lose sight of the big picture of how these corrections happen. Now, the market, as we predicted, has recovered its losses. The bottom was about 49.50. It was right in that zone where we lost one of our clients, and then they came right back in. That's how we pretty much knew it was the bottom, quite frankly. So now the stock market's hovering at the 5,900 point zone, and you are thinking to yourself, have I missed my opportunity to get invested? And I'm going to very clearly say to you today, no, because I still thought the S&P was a buy at 5,700. I thought it was a buy at 6,000. I'm going to say it's a buy at 6,150, which is the all-time record high. Why? Because if you're going to be an investor for more than 22 months, and by the way, if you don't have a 22-month time horizon, you have no business being in equities with your entire portfolio. But if you have a 22-month time horizon, and you're going to be buying stocks, especially the biggest and best like we do, you're going to be fine. You are going to live to see the S&P at 7,000 points, and that's going to be a brand new record all-time high. And it's not going to be a straight line up to the right. It's not going to be this perfect no bumps and no bruises and no speed bumps along the way move, but it will be a record brand new all-time high. And you will zoom out. You're going to look at your portfolio 5 years ago and 10 years ago, and you're going to say, over 5-10 years, I don't really remember the ups and downs on a day-to-day basis. I certainly don't remember the 20 reasons I wanted to panic last year, but you're going to be happy you stayed on your plan. And so that's what I tried to drive home on the show. Now, some of you have rightly pointed out, Nick, you just say the same thing every week on the show. And I'm like, well, yeah, pretty much. And why do I say the same thing every week, and with a little bit of caveats, a little bit of difference and differentiation? The reason I say basically the same message is because you get inundated with a bunch of nonsense all week long. And again, if you are going to watch the nonsense, you at least also have to watch our show for few minutes a week, because this is one of the few places you're going to get the message of optimism over time, and not just blind optimism, but reasons backed by math, data, statistics on why things are going to be okay over time. Now, what is my bull case for the future? I presented this to you in the past if you come to some of our events, but it's number one, baby boomers. It's number two, the emerging markets. And number three, it's the millennial generation. And this trifecta of growth is going to spur the economy to new heights. Now, I also want to share an interesting point with you this week about the tariffs and what's really going on behind the scenes. Obviously, you have to keep this identity of this person very confidential. But I was given some info about private equity right now, and companies that are dealing heavily with China, doing business in China, and dealing with the tariffs. And the issue is that these tariffs, if they go into effect, really will impact businesses, especially at the small and the mid-cap level. But one of the things that's also happening is, even though we were on a pause, remember we had the tariffs go into place and they took them off, now we're on a pause, now we're in an extension into the summer. Even with the extension now that we're dealing with, A lot of the companies in the private equity space, in the public space, are already, the ball is rolling. The train has left the station of them relocating out of China permanently. At least some of them are moving completely. Some of them are going to diversify their supplier lines a little bit, go to India, go to South America, and all these other spots. But the train has left the station. And so I don't know if this was planned out ahead of time. Maybe Besant had this figured out months ago or years ago. Who knows? But part of the negotiations here have been just to scare companies enough where they say we cannot rely on China exclusively anymore, and we certainly can't rely on China forever. We're going to have to diversify where we do our manufacturing. That is one of the silver linings of what's happened. So I actually think there could be very little impact to earnings. There's going to be some, and you could go into a technical recession. You could slip into a recession here. It's possible. I've talked about that. But when it's all said and done, I think the long-term impact is China's already paid the price since 2018 with the first round of tariffs. I think they're going to continue to pay the price for these tariff negotiations. And I think a lot of companies are going to say, you know what, let's not wait around and see what happens. Let's just get ahead of this. Let's move the factory. Now, it's not cheap to move the factory. It's not easy to move it, but you can do it. And so if you think the companies aren't looking at this, if they're not already pre-planning and the best executive teams on earth aren't thinking through how are we going to diversify, you're wrong. These companies are run by very, very intelligent people, people that go to work every single day to work these problems and have great solutions. They're going to figure this stuff out. But for China, I think the train has left the station. I think companies are already on the way out. So where do we want to be? From a portfolio positioning standpoint, again, I like the high quality. I like the large cap companies. If you screen the S&P now and you look at all 500 companies in the S&P and you're going to own them forever, just be careful because I think over time, the biggest and best will continue to provide better results. I think the biggest and best companies are going to naturally be higher quality. If you're already an indexer, if you already like the largest companies, well, we like to just own more of them. And that's how the portfolio is positioned. You're going to start seeing us do little moves in the market. One of the things, and this is not investment advice, but one of the things we recently did was add a little bit more to United Healthcare, went down again today. So you're going to see us look for opportunities like this. So if you're thinking to yourself, did I miss the boat? Did I miss the time to get into the market at 5,000? The answer is no. There's plenty of opportunities out there still. And again, none of this is individual investment advice, but I just want to give you some examples. United Healthcare now, since the peak, is down almost 60%. You've got companies like Tesla off the peak by 20, 30% still. You've got some companies like NVIDIA, they're still down off their all-time record highs. If we look at the large cap space, and we look at the high quality large cap companies that are down right now, you've got a number of great names that you can still buy at some reasonable prices. That mega cap space has actually done very, very well. It's held up the market quite well. But if we go into the next bucket, which is just simply large caps, you're seeing companies like Merck here down 25%. You're seeing Bristol Myers down. You're going to see Thermo Fisher here down about 27%. So there are plenty of opportunities out there. Again, none of these are individual recommendations. Don't go do this at home in your portfolio. But all that to say, there's plenty of opportunity to still buy stocks at great prices. So what does this mean? Well, eventually you're going to start to see the sector rotation continue. And what is sector rotation? It's the lifeblood of a bull market. It's where tech drives the return for 1 year, but then the next year it's financials, and then the next year it's energy, and then the next year it's real estate. You're going to continue to see sector rotation over the next couple months and years, I believe, and that is a good positive sign. I think there's going to be plenty of opportunities still with financials and some of the bank stocks. I think there's going to be plenty of opportunities with healthcare here. And when you see the bad news break, that's the time where people make most of their money. When you see the headline that everything is doom and gloom for a company, or that the world is falling apart for a sector, or that everything's horrible and awful for the market in general, that is the time where you become bullish and you make most of your profits over time. And again, not to give you a stock recommendation here, but just use this as an example. Facebook was down at one point about 70% from its peak. The company had gone from 150 a share down to 90. It was even worse at one point. And the stock was trading for 10 to 12 times earnings. And at Stenger Family Office here, we actually tripled our position. And again, not to say that we've been perfect on every trade, But just to give you an example of when things look bad for a company, sometimes you want to do the opposite and you want to be a contrarian and get in there and buy. And so that's what you're going to start seeing from Stenger Family Office is we are looking for opportunities. We are looking for ways to put some extra cash to work to rebalance the portfolio. We've been cautious not to just rush into the first leg of every single trade and just be patient. And I think that's how you're going to make most of your money over time. Easy example of this is everything looked horrible and awful for the energy sector in 2020. You could have bought ExxonMobil for $30 a share at one point. That turned out to be a phenomenal trade. Remember the Dow Jones Index? It's a committee. It's not just this passive index. It's an actual group of people. They kicked ExxonMobil out of the Dow, replaced it with Salesforce, and paid 1,800 times earnings for Salesforce, and sold Exxon at the low. And if you look at Exxon to Salesforce's performance over the past 5 years now, it's not even close. Exxon has smoked them. And so, again, that is the risk of just panicking and selling things at the low versus thinking critically about what's going on. Another example of this was March of 2023 during the banking crisis. You had just this tremendous opportunity to pick up banks like JP Morgan, Bank of America, where the baby had gotten thrown out with the bathwater. And everybody said that the financial sector was going to go through another 08 and 09. But in reality, it was select community banks that were having problems, and a lot people made a lot of money, our clients included, when we went in and bought financials on the cheap. So you're going to see this sector rotation. You're going to see the portfolio even out over time. And if you can be patient, if you can use critical thinking, if you can let your decisions be ruled by your plan and not by risk, you are going to make it over time. So I think the worst of the corrections behind us. I could be wrong, but I think we've seen the worst of it. And now we're going to see what the Fed does. And so the way we get to 6,700 on the S&P or 7,000 from here is really going to be Powell driven. And until you see the Fed stop its hiking cycle, and again, they haven't raised rates, but they've been tightening up their balance sheet here. Until you see that stop or slow considerably, you're going to see upward pressure on rates. That's why we've been short term with our duration on the portfolio. That's why we've kept your money very, very safe and short term, not going out and risking it in 20, 30-year bonds. So just be careful on your duration if you have fixed income in the portfolio, and own high quality. That's the Stenger Family Office recipe that we feel will be successful over time. Thanks for being here, episode 185. We'll see you next time for 186. Don't miss the virtual open house if you are a prospective client or a current client. Don't miss Investor Day coming up October 16th and 17th. And again, hit the subscribe button. We so appreciate you being here each and every week.